Welcome to the deep dive. Today we're digging into something called the Standard Index Select Annuity. It's offered by Diversified Insurance Brokers.
That's right.
And the idea basically is to see how this thing aims to, grow retirement savings, but also keep them safe.
A bit of growth potential with a safety net.
Exactly. We've got some informational text, the product details, and our mission really is just to help you, the listener, understand the key bits without getting lost in all the finance talk.
Yeah, cut through the jargon. So at its core, what we're looking at is a single premium deferred fixed index annuity.
Okay, single premium. So one lump sum payment in.
Correct. You put in that one sum, and then it's deferred, meaning it grows over time, tax-deferred usually, and it's a fixed index annuity.
Right, fixed index. That's where the S&P 500 link comes in.
Precisely. The potential growth is tied to the performance of the S&P 500 index, but, and this is key, with downside protection.
Okay, protection is good. How does that growth actually happen? How is it credited?
Well, there are basically two main options for how interest gets credited to your account.
Two ways, okay.
First, there's a straightforward fixed interest option. The rate's calculated daily, but it's guaranteed for a one-year period. Simple enough.
Like a regular fixed annuity almost?
Sort of, yeah, but just one option here. The other option is the index interest. This is the one linked to the S&P 500.
And this is calculated annually, right?
Annually, yes. And within that, you usually choose between two strategies.
Yeah.
One uses an annual point-to-point index rate cap.
A cap. So like a ceiling on the interest I can earn, even if the index skyrockets.
Exactly. Say the cap is 7%. If the S&P goes up 10%, you get 7%. If it goes up 5%, you get 5%. There's a limit on the upside.
Okay. What's the other strategy?
That's usually a participation rate. So instead of hard cap, you get a certain percentage of the index's gain.
Right.
Maybe it's 60%. If the S&P goes up 10%, you'd get credited 6% interest.
I see. So one limits the max rate, the other limits the share of the gain.
You got it. And a really important point for both these index strategies, any interest you earn is locked in each year.
Locked in, meaning?
Meaning, once it's credited to your account value, it can't be lost due to future market downturns. If the S&P 500 drops the next year, your previously credited interest is safe. Your account value wouldn't decrease because of that market drop.
Okay, that's significant. So you get potential gains from the market, but you don't risk losing principal or past gains if the market goes down.
That's the core idea of the protection element. And there's actually another layer, too, called the Guaranteed Minimum Accumulation Benefit.
Tell me about that. Sounds important.
It is. It's basically a promise about your principal.
Yeah.
After the surrender charge period ends, which depends on the version, like ISA 5, 7, or 10.
Right. Those numbers probably mean 5, 7, or 10 years.
Typically, yes, the surrender period length. After that period, the company guarantees that your account value will be at least a certain percentage of your net premium, the money you put in, minus any withdrawals.
And what are those percentages?
For the ISA 5, it's 105%. For the ISA 7, it's 107%. And for the ISA 10, it's 110%. So even if the index performance was flat or negative over the whole period, you'd still get back your premium plus a small guaranteed amount.
Wow, okay. That's quite a safety net. So who typically buys these? Is there an age window or a minimum investment?
Yeah, the issue age is pretty broad, 18 up to 93, though it might vary slightly by the specific ISA version, 5, 7, or 10.
93 is quite old.
It is. And the minimum premium is generally $15,000. It's suitable for both qualified money, like from an IRA or 401k, and non-qualified money, like from savings.
15,000. Okay. What about getting money out? Life happens. What if someone needs access before retirement?
Good question. There is some liquidity built in. After the first contract year, you can usually withdraw up to 10% of your account value each year without incurring surrender charges or a market value adjustment.
10% penalty-free annually.
Right. And then there are waivers for certain situations where you might need more or need it earlier. Things like terminal illness or confinement to a nursing home.
So specific hardship-type situations.
Exactly. Also, required minimum distributions, RMDs, from qualified accounts are usually allowed without penalty. And, of course, the death benefit payout to beneficiaries.
What about withdrawals outside those rules, like needing more than 10% early on?
That's where surrender charges would apply during the surrender period, and potentially something called a market value adjustment, or MVA.
MVA, what's that adjust for?
It adjusts the withdrawal amount up or down slightly based on the interest rate environment at the time of withdrawal compared to when you bought the contract. It's trying to reflect market conditions for early withdrawals.
Okay, something to be aware of for early access. Now, fast forward to retirement. How do you actually get income from this annuity?
You've got options there too. Quite a bit of flexibility. You can set it up for lifetime income just for you. That's a life-only option.
Pays as long as I live.
Correct. Or you could do life with a period certain. That means it pays for your life, but also guarantees payments for a minimum number of years, say 10 or 20 years. If you pass away early, payments continue to your beneficiary for the rest of that period.
Ah, okay. Protection for a beneficiary.
Right. There are also joint and survivor options designed to cover 2 lifetimes, usually a married couple.
Makes sense.
And, of course, you're not always forced into payments. You could potentially take lump sum distributions, depending on the situation and contract terms. Lots of ways to tailor it.
So wrapping it up, it sounds like this standard index select annuity is really trying to balance things. You get a link to potential market growth via the S&P 500.
But with features designed to protect your principal and lock in any gains you make along the way.
Right. Plus that guaranteed minimum accumulation benefit as a backstop.
Yeah.
And then flexibility in how you access the money later on.
That's a good summary. It's about participating in the sum upside while limiting the downside risk.
So for our listeners, the takeaway might be to think about where this kind of product, this blend of growth potential and protection might fit in your own retirement picture. How comfortable are you with market risk versus guarantees?
Exactly. It prompts questions about your own goals and risk tolerance. Definitely something to explore further if that balance sounds appealing.
Indeed. Well, thanks for walking us through that. That concludes this deep